Hank Parrott, your host. All right, when we were going off to break there, I was kind of getting into a few things about the stop loss, about the markets in general. The stop loss strategy is one to help manage risk, as we talked about. Jeremy had mentioned about the 12% when the market goes down. The S&P closes down 12% off of its most recent highs, that it gets triggered. And again, very unusual. In the first time in history, we've had 3 such triggers just this year alone. So that, again, it doesn't work every time, but it works over time, and it's done very, very well. And we've seen this in the numbers when we did the research with the stop loss and first started talking about it on air about, gosh, I think it's been about a year and a half ago. And one of the things with the stop loss strategy that you get into is understanding how it not only manages risk, but it also helps improve returns over time. And the research has shown that over time, in fact, it has outperformed the S&P by having the S&P with that stop loss strategy, a stop loss overlay applied. All of that being said, again, this is about how you approach your investing. This is just one strategy. There are a number of others. And Jeremy, you might want to share even some of the things that you use with your clients when you're talking to them about managing risk in the market, and how to, at a time like this, what kind of advice you're giving them.
Yeah, my advice is let's not put all of our eggs in one basket in terms of risk management strategies, even allocation strategies. This market is so volatile and has been really dependent on the Fed. Sometimes good news is bad news is good news. So it's really tough to see where the market's going. Instead of rolling the dice in one strategy, I am blending different risk management strategies, utilizing our firm's overlays, which is a different type of risk managed strategies, and some that are combining different risk managed strategies. That way, I know what our managers and models are going to be doing, and I don't have to worry about market declines as much. So diversification really is your friend this year. Good diversification is outperforming the market if you're in certain sectors or asset classes. So we're really trying to diversify through this market to mitigate risk.
You know, one of the things that we talk about with diversification is looking at your bond portfolio. This is an area, again, to illustrate another factor that has played in this year, a very unusual factor, in fact, has been that of the AGG, which is the Barclays Aggregate Bond Index. And what we see with that bond index, which out of the last 50 years, 49 of the last 50 years, in fact, has outperformed cash. This is the first year in 50 years that we're seeing the AGG underperform, if you will, cash. And that has, in fact, the AGG is down almost 17% year to date. To have bonds down 17% is very, very unusual. And Jeremy, you shared another stat with me, I think, on the 20-year Treasury being down at 35% year to date on Treasuries. And this goes to, of course, these are long-term Treasuries, but what people are seeing is more a time of things that we thought to be pretty safe and would reduce risk in a down market. We're not seeing those help out this time. So we're having to get more creative. There have been some changes there, ways that you can, other fixed accounts, if you will, other type bond funds that can help protect and have done better in this year's market, if you will, than what than the bond market, the broad bond market has done. Now, having said that, another one that I talk about a lot on the show is that of fixed index annuities. And there's been some great research pieces. And again, Barclays has one out there. Roger Ibbotson, I've talked about both of them. In fact, if you would like to get copies of these research pieces, and they're talking about, in this instance, these white papers have to do with how fixed index annuities outperform bonds or have outperformed bonds over the long term, giving you basically a better return and less risk, less volatility even than the bond market as a whole. So something, if you'd like to explore that a little bit more, just call my office. The number is 615-376 5325 and ask for one of those research pieces, or maybe you'd like to get a comprehensive financial plan done at no cost to you. All you need to do is call the office, 615-376-5325, and just let them know whether you're looking for one of the research pieces, whether you'd like to come in and get the complete comprehensive financial plan done, personalized just for you, or if maybe you got some questions and you want to call and talk to me on the phone, you can do that as well. 615-376-5325. When you call in, we'll get your information, send you out a packet of things to bring to your appointment with me, or if you're just scheduling to get the research pieces, they'll just send those out to you. If you wanted, again, to talk to me, they can schedule a phone appointment, and I'll be happy to answer any questions or concerns you may have there. Or like I said, if you'd like to come in and get that comprehensive plan done, we're going to look at income, your expenses, your assets, your liabilities. We're factoring in for cost of living adjustments on income, and of course taxes, reducing that income. We're looking at the expenses. We factor in for inflation more than ever today, right? That's a big concern. Then we look at your assets, your investments, talk to you about what's a needed rate of return on your money to accomplish your financial goals. Basically, all this information that we gather and the reports that we do are going to show you your financial future based on what you're currently doing, and then I'm going to share strategies with you on how to improve that future. Again, all at no cost, so take advantage. 615-376-5325. Again, you call in, we'll get your information, send you out that checklist of things to bring to your appointment with me. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, Jeremy, this is one of those areas that, again, people get overly concerned. They don't recognize, when the market is the way it is, one, there's the standard advice is you got to stay disciplined, of course, and ride that out. In particular at this stage, if you're going to sell out of the market and just put your money in cash, you basically have locked in those losses, and you're going to make it more difficult to recover from the bear market when the market does go back up, and the market will always go back up. So is there any other advice that you're, as far as what people might do at this time? Yes, it's stay disciplined, yes, it's hold course, but it's also maybe a good time to see if there's anything in that portfolio that you want to get rid of.
Yeah, absolutely. If clients are sitting in growth-oriented funds right now, that is not a good environment to be in a rising rate environment. So analyzing your portfolio, looking at different sectors, different asset classes, might be really good to get rid of some of those and look at non-correlated assets to the market right now. But being defense right now is going to be very, very important. We just don't know where the market's going to head and how far it's going to go down, especially if we tip into recession. So doing a portfolio checkup is going to be crucial right now if you haven't done that already.
This is one of those areas I mentioned again about fixed index annuities. So I'm going to cover just a brief little thing for you because I had some clients in earlier this week, and one of the things they had, these are new people coming in to see me for the first time and bringing in, again, what they're currently doing, and a couple of things they had were variable annuities. This is one of those areas where understanding how annuities work and the different types of annuities. So we have fixed annuities, and those are going to be like CDs, right? They're going to give you a set amount of interest for a specified period of time, at the end of which you may renew it and keep it there if you like the new rates, or you can move your money and do something else with it. And as I mentioned, those rates, with interest rates rising, we're seeing these rates go up as well. So here's something to keep in mind, and this is kind of that silver lining, if you will, on the cloud. When you're thinking of what the inflationary environment is, it's not a permanent situation. All right, when we look back over history and we see the last times that we had inflation like this, back in Carter's years as an example, when we had double-digit inflation, and by the way, if we still tracked inflation today the way we did back then, you would see very similar numbers. But to keep in mind that it is temporary. These aren't things that are going to be, oh my God, over the next 5 years, 10 years. It's not likely. I mean, in fact, most likely is that it's going to start coming down over the course of this next year. All that being said then, what you're looking at is a temporary situation where inflation is high, and normally I want to make enough money on my money, right? Enough return on my money rather, to stay ahead of inflation. Well, when it's running 8 and the market's down the way it is, that's probably mission impossible to try to get 10% plus returns in an environment like this, especially when we look at bonds and everything else at the same in the same way. What we're going to talk about, though, after this break is I'm going to get into more about how you can lock in a high rate right now. Over time, when the rates come down, you're going to be get a big benefit from that. I'll explain more about how that works right after the break. Join us here. We'll be right back on the Retirement Report.